Let's start this with a question. Will you retire without a mortgage payment? Odds are you answered that with either no or hopefully. Many Americans have resigned themselves to the idea that they will be making mortgage payments well after they hit the retirement age. In some cases, their mortgage will actually outlive them. That's a harsh reality, especially considering that many refinance every 5 to 7 years. We've already run the Mortgage Cancelator on people in their mid-40s, their 50s, 60s, and even 70s. One of them we did for 72-year-old. That's right. Imagine paying off your mortgage at 102 years of age. Not very encouraging. One thing that every financial planner agrees on is this, that retirement will be much, much better if you don't have a mortgage payment after you retire. There are 3 basic methods to paying off a mortgage. You know of probably the first 2. The new revolutionary Mortgage Cancelator is the 3rd one. The first one is make 360 regular payments. By the way, that's really good for the bank. Number 2, make some additional payments. Now that's a little bit better for you. The 3rd is a revolutionary Mortgage Cancelator method. This, I'm telling you, is going to be great for you. Wait till you see this. But let's cover the first 2 methods first so we get a baseline and understanding. In method 1, you're going to make payments for 30 years. That's 360 regular monthly mortgage payments starting at age 42. The mortgage is $325,000, 4.75% interest rate. Your payments on this is $1,695 a month for principal and interest. You're going to, by the time you hit 72, 30 years, 360 regular payments, you will have paid $610,326. Let's break that down. You started with $325,000 in principal. You're going to pay an additional $285,327, bringing your total to $610,326. Apparently there's a rounding there. $610,326. If you look at the chart on the right, the red is 87.8% of what your house cost. $285,000. Your house, you paid $325,000 for it. The interest rate is 4.75%. The interest volume is 68.7% on average for the first 10 years. In 10 years, you'll have paid $140,790 in interest, while reducing your mortgage by just $62,652. I want that to sink in for a second. You've paid all this money, over $200,000, $140,000 of it went to the bank, and they only credited your mortgage principal with $62,000. Look at that. It's over 2 times more in interest. Of your first $1,695 payment, $1,286 of that goes to the mortgage company. That's a whopping 75.9% of your payment going to someone else. You can see why this is a great deal for banks and mortgage companies, not so much for you. Your house will need to appreciate at an annual rate of 2.31% in order for you to just break even. It's a system designed to keep you enslaved to debt essentially forever, or rather until you die. And the average homeowner either refinances every 5 to 7 years or moves to a new house, restarting the clock. Method 2. Here's where we're going to make some extra payments towards the mortgage. We're going to start with one extra monthly payment of $1,695 per year. This will reduce your interest paid to $237,000. Mortgage paid off in 25.6 years. Now this is a little bit better, saving you 53 months of payments totaling $89,835. You're not going to have to pay the mortgage company. What did it cost you to get that savings? $42,375 in additional payments. That's a pretty good return. More than double, right? Second year, $3,390 a year, reduces your interest rate paid to $204. Pays it off in 22.4 years. That will save you 91 months of payments totaling $154,245 for your $74,580 additional payments. Still pretty good returns, still more than double. Third one, $5,085 per year will reduce your interest paid to just $179,698. Pays off in an even 20 years, saving you 120 months, totaling payments of $203,400, and you paid additionally $101,700, meaning again you doubled in savings what it cost you. That's a great return. Okay, so I'm going to show you the graphs. The first one here is the one payment. See the red starting to come down, the green coming up a little bit, the yellow coming up. The next one is two payments. It drops some more. You've invested a little bit more in additional payments. It saved you a lot more. Next, it drops down even more in the amount of interest you paid. You paid additional, this much additional, and look at all the saved payments that you made. So that's pretty good. So you can see the value of adding extra payments. However, the money you use to accelerate paying down your mortgage stops working for you, and it can no longer grow using compounding interest. Albert Einstein said, compounding interest should be the eighth wonder of the world. This is one of the smartest guys of the 20th century. He says that the eighth wonder of the world should be compounding interest. How brilliant is that? He also said poor people pay interest while rich people collect interest. Look, let's see what we can do about getting you out of the paying interest side of this, where you can accumulate a lot of cash and you can actually turn into a place where people pay you interest. So you could be collecting interest instead. Okay, so the Mortgage Cancelator system gives you the best of both worlds. Paying your mortgage off early, saving interest, saving a ton of mortgage payments, and letting the money you use to pay down your mortgage, it'll continue to grow at a 4% compounding rate. You're probably wondering, how is that even possible? Well, let me tell you, the wealthiest people on this planet have been using this system to amass huge amounts of tax-free wealth, and now you are about to learn how as well. There's a financial instrument that gives you this power and ability to take control of your financial future, just like the wealthy do. You've even heard of it and may even have one, but no one has shown you it has this kind of power and benefit until now. Regardless of which method you use to pay your mortgage, each one requires that you carry mortgage insurance. This policy is designed to protect the banks and mortgage companies, not you. You can waste your money on a mortgage insurance policy that will expire worthless unless you die, heaven forbid, or you can leverage extra payments to pay down your mortgage by purchasing a specially designed permanent life insurance contract along with a myriad of its long-term benefits. So let's pull back the curtain and let you in on just how this works. For our example, we'll use the same $325,000 mortgage at 4.275% interest with monthly payments of $1,695. Let's take the three extra payments used in method 2, and instead of putting that $5,085 each year towards the mortgage, you'll use it to pay the premiums of this specially designed permanent life insurance contract. When you make your premium payment for year 5, you'll immediately have access to $13,592 in your cash values from your policy, which you can now leverage to pay down your mortgage. By year 5, your mortgage will only have been reduced to $297,370, but you will now accelerate its pay down by $13,431 in one fell swoop, saving you thousands in interest and leapfrogging literally dozens and dozens of payments. By year 10, you've accumulated money in your cash values again to the tune of $23,284, which you'll ask the insurance company for, and they will gladly give it to you because they are under contract, and you have the first right to use that money. Your mortgage gets reduced by another $22,015. Year 15 reduces by $19,193. Year 20 reduces by $15,386, paying your mortgage off in just 282 months or 23 years and 6 months. Great for you. Even though you've pulled $66,379 from your policy to accelerate paying off your mortgage, that money is still growing at a compounding rate of 4% annually. Another thing to note here is that each year the insurance company is paying you a tax-free dividend, which is contributing to your cash values. So the insurance company is actually helping you pay your mortgage off as well. At this stage, you're out from under the weight of the mortgage about 6.5 years ahead of schedule. So now it's advisable to do what? Pay yourself that last 6.5 years and put that money into your policy. Unlike standard mortgage insurance that expires worthless, this is your result at age 70. On the left side, you see it's 29.9 years, 0 payments saved, 0 interest saved, death benefit 0. It'll cost you about $10,000, $12,000 in a mortgage insurance policy that's going to expire worthless, and it will not build any cash. As opposed to the right side of the scale that isn't so much tipped in your favor. We're going to pay off the mortgage in 23.4 years, saving you 79 payments. The amount is $133,905. Total interest saved $65,000 in interest that would have gone into someone else's pocket. Your death benefit at age 70 is $250,000 tax-free that's going to continue to grow. You'll be able to pass on. So you have a $325,000 house that's paid off, and you have a tax-free death benefit of $250,000 that you can pass off to your heirs. What did it cost you for that $250,000? $114,000. You will have accumulated $125,000 in cash by the time you're age 70. Then the icing on the cake. There's accelerated death benefits that go along with this. Chronic illness of almost $174,000. Chronic illness and long-term care like nursing facilities and nursing homes. Terminal illness, if you get diagnosed and you're terminally ill in the next 12 months, you'll have almost $199,000 you'll be able to utilize for whatever it is you need. Specified medical, another $136,000 for things like heart attacks and strokes. So you can see why this is so much better for you. And with a couple of tweaks, we can get it down to 21.8 years, saving you 99 payments. Look at this. Here's what it was. We did a couple tweaks, ran this. It saves you you're down to 21.8 years, saves you 99 payments, $167,000 in saved payments, $77,000 in interest. The benefits are about the same. Chronic illness is a little bit more. Everything came up a little bit more because we're able to put a little more cash back into the policy. And though you spent probably about $8,000 more using the Mortgage Cancelator system, you can see the incredible difference in your return. Several $100,000 in benefits that had you paid separately for would have cost you an additional $120,000. See why we say great for you. Here's the graph. The red dots are the plan that you're currently on. The green shows that year 5 we pull it out and apply it to the balance of the mortgage. It comes along in year 10 we do the same thing, drops down, and it starts accelerating. See, the difference between these two dots is greater here. In year 15, it accelerates it even faster. Year 20, very fast until finally it's paid off in year 2023. Okay? While everyone's situation is a bit different, the principle is based on math, and numbers don't lie. So fill out the Mortgage Cancelator form with your basic information, and your agent will get with you to see exactly what it can do for you. Here's a picture of it. This is usually behind this video. So as soon as you get done watching this video, you can turn right around and put that information in. It'll give you a free report, and it'll notify your agent that you have input your information, and they'll start working up your cancelator progress. By the way, this won't work with just any insurance company either. That's why we've selected one of the best in the industry, which has paid dividends even during the Great Depression and the most recent Great Recession. It's been established over 100 years ago. It's on AM Best A+ superior rating, Standard & Poor's AA rating, 95 Comdex rating, which means it's as good or better than 95% of all of the other insurance companies out there. It's a Fitch AA rating. It's a mutual company, which means it's not owned by stockholders. It's owned by the policy holders like you would be. It's also a non-direct recognition company, which means that even when you have money out of the policy using it to pay down your mortgage, you're not penalized with the dividend. You get full dividends like everybody else does. Don't worry about the extra payments needed for the premiums either. Our agents are trained to help you find the money in your existing budget. You'll be surprised at how much you really have to make this work. If you get paid weekly or semi-weekly, that's every other week, you'll have a windfall of extra paychecks that typically just get spent. If weekly, you'll get 5 extra paychecks per year. If semi-weekly, you'll get 2 extra paychecks per year, and in some years, 3 extra checks. Another place to look is if you get federal tax refunds each year. If you get refunds, why would you let Uncle Sam use your money interest-free for months and months and months? The answer is you shouldn't. We can show you how to increase your deductions so you can have that money to build a policy so you can get out from under your mortgage quicker. And we have a few other tricks up our sleeves that can help you find even more money to help accelerate paying off your mortgage even quicker, saving you several more months of payments. So don't hesitate. Give your agent a call or fill out the Mortgage Cancelator form now. This is a no obligation consultation, and at the very least, we'll make sure you get the mortgage insurance that is needed, but structured so that if in the future you want to apply the Mortgage Cancelator method, you'll be able to. Thank you for your time. We hope this has been enlightening and helpful, and we look forward to serving you.